This is going to completely change the dynamics that have existed for investors over the last decade. Pretty much everything that worked while the Fed was inflating this bubble is not going to work as the air comes out of it. And the air is going to come out of it. Despite whatever efforts the Fed may pursue to prevent that, I think they've already pricked this bubble, and there's really no way to prevent it from deflating. Clearly, we have a huge inflation problem. And we've had this inflation problem for over a decade. It's just that it hasn't manifested itself in a way that was problematic to the Fed or to investors because the inflation was resulting in asset prices going up rather than consumer prices. I mean, consumer prices went up, but not by an amount that caused an alarm, especially since the government was able to disguise the true degree to which prices were rising with the CPI, which doesn't really do a good job, I think, by design of accurately reflecting what's happening in prices. It substantially understates the degree to which prices are going up. And so given the ability of the government to pretend that we had inflation below 2%, that gave the Fed cover to continue to create more inflation under the guise of quantitative easing and stimulus and 0% interest rates. But that money flowed primarily into financial assets, but it also fueled a record increase in U.S. trade deficits. In fact, this morning, we got news that the December trade deficit was a new record, $101 billion. That is the first month where we've had a trade deficit in excess of $100 billion. This is merchandise trade. And for the entire year, our trade deficit in goods eclipsed $1 trillion. That is an unheard of deficit. Never before has anything that bad been achieved, by any nation. And so part of that actually kept a lid on inflation, even though the way the government measures inflation, we had a 7% increase in consumer prices. Imagine how much more consumer prices would have gone up had $1 trillion worth of stuff not been dumped into our market by our trading partners. And how did we pay for all this stuff? We didn't. We printed money and we exchanged the money we printed for the goods that the rest of the world produced. And Americans didn't even earn a lot of the money that they spent. It was just handed to them by the government in the form of stimulus checks or other bailout money. And where did that come from? Well, it came from the Fed's printing press. We did the worst possible combination of monetary and fiscal policy in 2000 when we first entered, the pandemic, March of 2000, because as the economy was shutting down due to government restrictions, instead of doing the right thing and contracting money supply along with the economy, so demand would go down with supply, the government and the Fed conspired for the worst combination of monetary and fiscal policy, probably in the history of the United States. As millions of Americans were leaving work, the government mailed everybody checks to replace their paychecks. But the key is when you're earning a paycheck, you're being productive. You're helping to produce goods and services, and then you're rewarded with pay. And now you can consume some of the goods and services that you help produce. But when you're not working, you need to consume less. But the government didn't want that because that would have meant a more severe recession. So the government sent everybody money to buy goods and services that they weren't producing. And the fact that we have big shortages should not have been a surprise. I mean, it's an obvious consequence of a failure to produce. You don't have stuff and you get a shortage. But we had all this extra demand thanks to the government and the Federal Reserve. And we haven't even really begun to feel all the consequences of that inflation. I think the inflation that we've experienced in 2021, a lot of that was largely the delayed consequence of the inflation that was produced prior to 2020. I don't even think we've caught up to that inflation yet, which is one of the reasons that we're going much higher. Not only wasn't inflation transitory, but it's going to be far higher than it was during that supposed transitory period when the Federal Reserve was claiming that the inflation we were experiencing would be transitory. At the time, I said the Fed was lying about that. I said that inflation was as transitory as the subprime market was contained. That's exactly the lie that the Fed told us in 2007 when the mortgage market blew up, the subprime market. the Fed told us not to worry, that there wasn't going to be a problem, that the damage was contained to this small segment of the mortgage market. It wouldn't affect the overall housing market. It wouldn't affect the economy. And of course, we ended up with the 2008 financial crisis. I think in many respects, people at the Fed might not have even believed those lies, but they told them anyway because they wanted to placate the markets. They didn't want the markets to be afraid of what was going to happen. And I think that was pretty much what they were doing again this time. They didn't want to level with the markets and deliver the bad news about how bad inflation was going to be. So they just pretended it was transitory. Now, maybe they also hope that the problem will go away. In fact, they're still hoping it's going to go away, because if you look at what Powell is talking about doing in order to fight this inflation that it now admits wasn't transitory, is too little too late. What is the Fed proposing? Well, in March, they may raise interest rates from 0, where they remain, to 0.25%. And then maybe by the end of this year, they will have raised interest rates up to 1% at the end of this year. And then maybe at the end of next year, they will raise interest rates to 2%. Now, how are you going to do something about an inflation problem by throwing gasoline on it? Because a 1% interest rate, even if we get there at the end of the year, is still a stimulative rate of interest. In fact, 1% is the rate that Alan Greenspan slashed interest rates to in 2002 when he wanted to stimulate the economy following the September 11th attacks and the collapse of the NASDAQ bubble. That was considered a very stimulative monetary policy. Yet somehow now it's an aggressive tightening that's going to take care of the worst inflation in 40 years. And the reality is, it's not the worst inflation in 40 years. It's the worst inflation ever. Because 40 years ago, when we were measuring inflation, we were using a very different CPI than the one we're using now. So you can't really compare the CPI today to the CPI 40 years ago when they're completely different. So if you measured what happened to prices last year with what happened 40 years ago using the same CPI that was being used then, in 2021, we had an increase in consumer prices of about 15%. And that would make it higher than any year of the 1970s. In fact, it would be higher than 1980, which until last year was the high watermark for the CPI at 13.5%. But how did we put out the inflation fire in 1980? Well, Paul Volcker brought interest rates all the way up to 20%, so that we had a real rate of interest of 6.5%, and we created a powerful incentive to hold on to US dollars and to save money, because we offered savers a very high real yield on their savings. And of course, Treasury bond yields also soared. I think the yields on 30-year bonds got up to something like 14%. And so we were offering a positive yield. Well, even if the Fed follows through with their commitment to raise rates to 1% by the end of the year, inflation, even if you believe the government's numbers, which I don't, at 7%, 1% is still a negative 6% interest rate. You are not going to encourage savings with negative 6%. You're not going to discourage debt. You're not going to do anything to change the dynamic. You're not going to get out in front of the inflation curve. You're going to fall further and further behind if you continue to stimulate with cheap money. Now, yes, it's not as cheap as it was if the Fed allows rates to rise to 1%. But if inflation continues to accelerate, which it likely will, real interest rates will actually be falling, even as the Fed is slightly raising nominal interest rates. So they're actually pursuing a more stimulative policy while pretending to tighten. And of course, the Fed continues to print money. It continues to monetize government debt. Not only have they not stopped the presses, they're still cranking them up. They continue to buy U.S. government bonds and mortgage-backed securities. Now, the Fed is saying that they're going to wind that down, but they haven't actually done it yet. So they're continuing to make this inflation problem worse. But here is the bigger problem. The only way the Fed was able to justify these artificially low interest rates and quantitative easing was under the pretense that an absence of inflation gave them the leeway to do that. In fact, they actually had the gall to claim that inflation was too low, when it was below 2%, even though had they measured it honestly, it would have been above 2%. But using the rigged data that they had, they were able to point to an inflation rate of 1.5, 1.6, and claim that that wasn't enough, that we needed 2%. That their mandate was 2% CPI, which of course it's not. Their mandate is price stability. So stable prices are prices that are flat. They don't go up. If their mandate was 2% increasing prices every year, then their mandate wouldn't be price stability. It would be prices going up by 2% a year. But they kind of redefined their mandate to a rising cost of living. And then they claimed that the cost of living wasn't rising fast enough. And therefore, they were going to pursue this easy money policy in order to deliver a more substantial annual increase in the cost of living. Now, apart from the pure nonsense of that argument, because too little inflation was not a problem. In fact, any inflation is a problem, and the more you have, the bigger the problem. But now that inflation is triple or more, 2%, there is no way the Fed can justify maintaining the artificially low interest rates, because even if they raise interest rates to 1 or 2%, they're still artificially low. And there's no justification for that if you're going to claim it's because inflation was too low. Now, inflation being too low was never the real reason. That was just the excuse that the Fed gave. The only reason that the Fed kept rates so low was because we had such a gigantic debt bubble that those low interest rates were the only thing keeping us afloat. If interest rates were allowed to normalize, we would have a far worse financial crisis than 2008. We would have all the big banks that we bailed out failing. We'd have a crash in the stock market. We have a crash in the real estate market. And not only would the private sector have difficulty servicing its debts if the Fed were to allow interest rates to go to a natural level, but the United States government would also be in the same predicament, maybe even in a worse predicament. The U.S. government would be forced to default on its national debt. We've got a $3 trillion national debt right now, and it's financed at 1%. And it's not financed at 1% with 30-year government bonds. It's financed with 90-day T-bills. The government has to constantly roll over this low-yielding debt in order to keep the financing at 1%. Well, 1% of 30 trillion is 300 billion. Well, what if interest rates went up to 10%, which is half of what they got to in 1980 under Paul Volcker? 10% of 30